Hello, hello everyone. I'm Dr. G. Manimuthu from Mannar Thirunai Naikar College, Department of Commerce. Today we are going to discuss about cash flow statement in management accounting. First, we know the meaning of cash flow statement. It is a statement, the flow of cash. It is the statement express the flow of cash. The flow of cash, which means what are the cashes or inflows and the outflows of expenditure in nature. So cash flow includes each inflows and outflows, cash receipts and cash payments during a period, movements of cash or vital importance of the management. The short-term liquidity and short-term solvency position of a term are dependent on its cash flows. A basic objective is a cash flow statement. It is a portrays changes in cash position between two accounting periods. So, meaning of cash flow statement. A cash flow statement is a financial statement that shows the actual movement of cash and cash equivalents in and out of a business during a specific period. Which where cash comes from, that is inflows, where cash goes, that is outflows. If you are spending expenses, the cash is outflows. If you are buying machineries, the cash is outflows. If you pay the salary, the cash is outflows. So what are the sources, the cash you have to spend in the terms in this place, the cash or outflows. At the same time, what are the sources of cash inflows? Say for example, if you are lending a loan from a bank, it is a credit, but even you have to receive the cash from bank. So the cash is inflow of your business. Then capital is a long term liability. You know that capital, it is a long term liability. So in long term liability, the capital, the fund rise. So in this head, the fund is income to the business. It is an incoming flow of business. So these are the cash flow statement meaning. Then we are going to discuss forms of cash flow statement. What are the forms of cash flow statement? Format of cash flow statement. The cash flow statement, cash flow, it's basically starts with an opening balance of cash and bank balance. The statement, it starts with an opening balance of cash and a bank balance. So first opening balance of cash and opening balance of bank balance. Then add what are the sources of inflows. Already you are having a sum of money, say for example 1 lakh, then and also adding what are the incomes you should be received, what are the inflows you should be received. So next, the add overhead is sources of cash. What are the sources you have to receive from the funds? First one, cash from operation. Cash from operation is nothing but the current liabilities and the current assets, current inflows and current outflows, the net value is called as a cash from operation. So first we should take the balance of cash from operation, then issue of shares. In case issue of shares, the shares will out to the business, but the fund are mobilized from the business. The issue of shares is nothing but the mobilization of funds, mobilization of capital. So the issue of shares is raising of funds. So the surely inflow. Then issue of debentures. Same thing, shares and applicable for the debentures. Debenture also issue the bond to receive the money. Then sale of fixed asset. If you are selling the fixed asset is gone out from the business, but you will be received from the you will be received the cash. So that is the inflow. Then sale of investment. If you are selling the investment document is allowed, but the income is received. Then long term loans. If you are buying loan from the bank, it is a credit term, but now in the sense you will be receive cash from the bank for lending purpose. Under one, total sources. So these are all the overheads. It's a total sources. Then now we are adding bank opening cash and bank balance, then add total sources. Now we get a total cash available. Then we are deduction application of funds. What is application of funds? In what are the sources you have to spend the money, in what is whatever you may be, you have to paid. That is called as an application of business. Even if you are buying machinery, it is also application of business. So cash outflow and account of operations, some of the expenditure is in the head, under the heads is come to the cash outflow and account of operation. Then redemption of preferences. In case issue of preferences, the cash was received, the share was issued. But redemption of preferences, the share was received, the cash was issued. You have to repay the cash value to the share amount. So you have to redemption of shares. The same thing is applicable for redemption of debentures. Then loan repaid. If you are getting the loan, it is a inflow. Same time your payment of the loan is outflow of cash. Then tax paid is a purely expenditure, you have to pay the cash. Then dividend paid. Then dividend paid. What is the dividend paid? Dividend is a profit. Preference shareholders or any kind of shareholders, they have to pay a share profit amount is called as a preference. That is interim dividend. Nothing it maybe a interim dividend or dividend. So dividend is fully paid the cash, so you have to pay the cash dividend paid. These are the heads under the application of cash is called as a total applications. Now we are the balance of cash. How to get the balance of cash? We are total sources of cash funds, cash available, deduct application of cash. The net value is called as an bank balance. It is a cash flow statement. The cash flow statement is essentially cash flow statement is essentially for the management, because the management should know what cash is available, how much of cash is available. That is only they are able to run the business. That is only for able to available to run the business, how to maintain the short term deficiency, how to solve the short term liquidation, short term solvency, short term difficulties. So every management, they should keep a cash flow statement for running capital of business. Thank you.